Today, the Bank of Canada cut the rate by a quarter point, and at the same time, condos are popping up again at around $350,000. So in this video, I'm going to show you why this cut happened, what the prices really mean, and how you can tell the difference between a smart buy and a future headache. So the Bank of Canada cut rates this morning, a small move, just 0.25%, but it's loaded with signals, and here's how to read into it. Inflation cooled down with August numbers showing headline inflation at about 1.9%, close to that 2% target that the Bank of Canada is always aiming for. Core inflation is still around 3%, but that's a lot lower than last year, which is also one of the reasons why the bank was finally comfortable dropping the key interest rate again after holding it during the last 3 consecutive meetings. The economy is also slowing down. So in the last video, we talked about GDP shrinking by 0.4% in the second quarter. Job growth is flat with unemployment hovering around 6%, showing the labor market is slowing down. Households have been also cutting back. Consumer spending on non-essential like dining out and also buying random things that we don't really need is also dropping. So this cut makes sense. And now goes south of the border, the US Federal Reserve is also moving toward easier policy, meaning that they're preparing to lower rates to support growth as well. But our economy is weaker, so Canada had to move first. So now what does this mean for you? If you have a variable rate mortgage or a home equity line of credit, payments should be dropping as prime rate falls. If you're shopping, fixed rates might also see some relief if bond yields follow, since lower yields directly reduce the cost of lending for banks. Let's say on a $500,000 mortgage, this rate cut saves about $75 a month. On $400,000, it's $60. On $600,000, it's about $90. And on an $800,000 mortgage, which is common these days with GTA average prices around $1.022 million and a 20% down payment, the savings are about $120 a month. So one cut won't change your life, but 2 or 3 more, you'd be looking at an extra $200 to $300 a month staying in your pocket. The next potential rate cuts are October 29th and December 10th this year. And there's kind of a psychological impact as well. It tells buyers the wind is shifting. And in the real estate market, that shift can be enough to bring people back into the market. So with rates moving down, what's happening to home prices? Because if the bank is cutting and condos are showing up at $350,000 again, are these real opportunities? 135 condos listed at $350,000 or less are available on the market as of today. A year ago, there were only 28. Do the math, and that's almost 5 times the inventory in this price range. Obviously, there's going to be a catch. Not every unit at this price is a deal. Some are going to be in buildings that have always sold at lower prices. Maybe there were construction issues, or management has a poor history of management, or maybe maintenance fees have a habit of going up more often than they should. Others might be micro units, tiny sub 400 square foot spaces that look good on paper but feel like an actual shoebox. Hard to live in and harder to sell, especially in this condo market where sellers are at a disadvantage. But then there's also the rare finds that are more guaranteed to sell in less than the average 40 days on market. These are units that are livable 1-bedrooms with real doors, not those sliding ones, good windows so you actually get sunlight, smart layouts without wasted space, and also good property management. So when you see a $350,000 price tag, just remember this: the price is the hook. The value is hiding in the building, quality, the management, the fees, and the floor plan. You have to consider these things too, because it's so easy to get excited over a $350,000 listing, but it's only half the story. The real challenge is figuring out which units are true deals and which ones could become money pits with units that look cheap up front, but drain your wallet later with high fees or constant repairs. And this is where most buyers get stuck. They see a low price tag and think it's automatically going to be a deal. So here's exactly how to tell the difference. Number 1, check the building health. Look at the status certificate for a strong reserve fund and any special assessments. Number 2, you got to study the maintenance fees, track them over the last 5 years. A low fee today doesn't help if it jumps 8% tomorrow. Number 3, layout and livability. Units with good light, storage, and real rooms that hold value. A shoebox in the sky could be a struggle for you to sell in the future. Number 4, think about rentability. Even if you plan to live there, you need an exit option. Think about if someone else would rent the unit. Number 5, remember location trade-offs. Sometimes a less flashy area with a healthy building is better than a brand name address with problems. Now for buyers, how do you negotiate after a rate cut? First, update your pre-approval. Make sure your broker reruns the numbers, because the monthly savings from rate cuts can increase your qualifying amount and also boost what you're approved for. Second thing you should do is target listings that have sat on the market. These are the sellers that are ready to talk. The average days on market for condos in the GTA ETA is 40 days. Look for those condos and make sure you're also checking their total exposure from previous listings that were terminated. The third thing is use fees as a lever. If maintenance is higher or looks like it's about to go up, price it into your offer. You don't even have to be shy about telling the seller this, because in some cases, they'll agree with the buyer. The fourth thing that you need to remember is that the terms of an offer can win. Strong deposits, clean conditions like no financing or inspection, and a flexible closing date. Sometimes that can be all it takes to beat a higher price in any real estate market that you're negotiating in. And finally, bring evidence. Comparable listings that support your offer price. Show the history of maintenance fees going up. Showing that you've done your due diligence and your homework can put you in a stronger position to win in this market. But now let's be honest about risk. Core inflation is still around 3%. If it pops up again, rate cuts can slow down. The US could also shake things up. So just remember, you're buying the building just as much as the unit. Now you know how to protect yourself and how to negotiate smartly. Now you also need to know where the actual opportunities are hiding. How do you know which types of buildings and neighborhoods make the most sense in this market? Well, let me tell you. Older mid-rise buildings that have already handled their big repairs and have strong reserve funds. For example, a lot of 1980s and 1990s Toronto buildings along Yonge Street, or in Scarborough that have completed window replacements and roof work. Those are good opportunities. One bedrooms with livable space that have well laid out units in areas like North York or Etobicoke that also have real bedrooms and decent natural light. Units with cosmetic issues you can't fix, like floors or paint, not structural issues or bad management you can't fix. And also look at neighborhoods just beyond the core. For example, areas like Scarborough, East York, or parts of Mississauga. These areas could have like an extra 10 minutes on transit and can save you $50,000 to $100,000. So what you can do is watch for four main signals. Inflation needs to stay close to 2%. GDP and job data will show whether the slowdown gets deeper. Ontario's growth forecast just came down, and the province is expected to grow more slowly than what was previously predicted. And now, of course, watch the Fed in the US, because their rate decisions directly influence Canadian bond yields and mortgage rates. If those stay on track, we could see more rate cuts. And more rate cuts translates into more confidence in the real estate market and more opportunities at the entry level, like we've already been seeing with the 480% increase in this price range since last year. But don't get too excited just yet. Just because $350,000 condos are back and the overall condo market is down and the Bank of Canada just cut rates, the opportunity is real only if you buy the right building with the right management and also the right layout. Keep all that in mind and you'll find success. New videos are out every single week if you want the best tips to help you reach your real estate goals. Thanks for watching, and I'll see you in the next one.